Okay, let's dive right into this explainer. Look, if you're a busy real estate investor, time is literally your most precious asset, right? So today, we're cutting straight through the noise. We're doing a high-level briefing on scaling operations and mastering forced appreciation in the multifamily sector. We're going to break down exactly how tweaking your operations directly impacts your total asset valuation. Let's get focused and check out the blueprint.
So here's a fundamental question you really need to ask yourself. Are you buying bricks or are you buying an income engine? Think about it. Managing 50 scattered single-family homes, that means dealing with 50 separate roofs, 50 insurance policies, and 50 distinct geographic locations. It's an absolute logistical nightmare. But when you bring those 50 units under one roof, you completely transform your real estate into a unified, predictable operating business. To really crush it in the multifamily space, you've got to look past the physical bricks and mortar. You need to see the asset for what it truly is, a well-oiled income engine.
Here's our agenda for today's explainer, laying out a precise, logical path to that ROI payout. First up, the power of scale. Then we'll expose a massive pitfall in the economic vacancy trap. Third, we'll map out the value-add timeline. And finally, we'll run the numbers on the forced appreciation math. All right, kicking things off with Section 1, the power of scale, multifamily efficiency. Let's move to how this actually builds. You see, the fundamental power of scale in multifamily isn't the building itself. It's the individual tenant lease. Since residential leases and commercial properties, and by that I mean 5 units or more, typically turn over every 12 months, you get this amazing, recurring opportunity to reset your revenue to market rates. This makes multifamily an absolutely incredible hedge against inflation. Now, looking at operational scale, properties usually fall into 3 distinct tiers. First, you've got small scale, 5 to 20 units. It's an accessible entry point, sure, often owner-managed or run by a boutique local manager, but honestly, operational efficiencies here are pretty minimal. Then we hit the transition zone, mid-scale, around 21 to 80 units. It's big enough for part-time maintenance and third-party management, but it usually lacks a full-time on-site leasing office. But the magic truly happens at the institutional scale. We're talking 81 units and above. These are fully self-sustaining ecosystems. They easily support a dedicated on-site property manager, a full-time leasing agent, and dedicated maintenance crews. This level of scale is exactly where your efficiency peaks, and you can really maximize your operational focus.
Moving on to Section 2, the economic vacancy trap, also known as the silent killer.
Okay, picture this. A broker hands you a glossy offering memorandum, and right there at the top, it proudly shouts that the building is 95% occupied. Sounds fantastic, right? Well, hold on a second. Your immediate response to that broker needs to be, wait, is that physical occupancy or economic occupancy? Failing to grasp the stark difference between these two metrics is a shockingly fast way to lose capital. Look, physical vacancy is just a simple head count. If you own a 100-unit building and 5 apartments are empty, boom, your physical vacancy is 5%. But economic vacancy? That's entirely different. That measures the gap between the total rent your building should be collecting versus the actual cold, hard cash hitting your bank account. A building can easily be 95% physically occupied while simultaneously suffering from a devastating 15% economic vacancy. It happens all the time.
Now, what's really interesting is exactly why this discrepancy happens. Economic vacancy is usually driven by 3 silent revenue killers. Number 1, concessions. You know, giving a tenant 1 month free just to get a lease signed. The unit is physically occupied, sure, but you definitely aren't collecting the full gross potential rent. Number 2, model units and employee apartments. These are units pulled entirely off the market to serve as showrooms or maybe free housing for your on-site staff. And number 3, which is by far the most dangerous, bad debt. These are tenants who are physically living in the property but have simply stopped paying rent. They're actively consuming utilities and wearing down your asset, all while generating 0 income. It's a total drain.
Next up, Section 3, the value-add timeline, execution strategy.
Now that we've pinpointed those revenue leaks, it's time to pivot. We're moving from identifying problems to actually rolling out a concrete, sequential action plan to plug those leaks and force massive property appreciation. To really get our timeline, we have to ground our strategy in the fundamental math of commercial real estate. A value-add strategy means you are systematically executing operational and physical improvements to increase your net operating income, your NOI, or to decrease your expenses. Why does this matter so much? Because the value of a commercial building is strictly determined by its NOI divided by the market capitalization rate, or cap rate. So forcing equity is really just a matter of manipulating that NOI upward.
So, here is the exact step-by-step blueprint we deploy. In months 1 through 3, it's all about operational stabilization and tech integration. You immediately audit tenant files,
Execute necessary evictions to clean up that bad debt we just talked about, and transition all those paper and check tenants to an online management portal like AppFolio or Yardi, so you can enforce automatic late fees. It's a game changer. Then, in months 3 through 6, you shift focus to exterior and amenity upgrades. Curate that curb appeal first. Repaint the facades, modernize your signage, and update the landscaping before you ever touch a single interior. This actually lets you command higher rents before a prospective tenant even steps foot inside. Finally, months 6 through 24, the interior renovation rollout. As old leases expire, you take the unit offline for a fast 14-day renovation, installing durable, premium finishes. Think luxury vinyl plank flooring and quartz countertops.
But listen, true operators don't just stop at base rent. Step 4 of the blueprint is ongoing. Activating ancillary revenue streams. Look at these incredible opportunities. You can monetize underutilized spaces by adding covered carports, implementing monthly pet fees, or even installing rentable storage lockers. And crucially, you want to introduce a ratio utility billing system, commonly known as RUBS. This is a standardized utility bill-back program that passes water and trash costs directly back to the tenants. It drastically lowers your operating expenses.
Which brings us to Section 4, Forced Appreciation, the math.
Okay, let's slow the pacing down for just a second, because this is where the theory turns into massive financial reality. We're going to look at a before and after case study of an 80-unit apartment building operating in a stable 6% cap rate market. By cleanly executing the operational blueprint we just walked through, you can achieve a total monthly revenue increase per unit of exactly $185. Let's break that down. That's an average interior rent premium of $150, plus $25 from implementing your RUBS utility billing program, plus $10 in premium pet and parking fees. That gives you $185 per door per month.
So, the crucial point here is what happens when you multiply that all out. Take that $185, multiply it by your 80 units, and then multiply that by 12 months. Boom! That results in a massive $177,600 increase to your annual net operating income. You haven't just painted some walls, you fundamentally and structurally improved the business engine.
And here is the absolute ultimate payoff. Remember our formula from earlier? Value equals NOI divided by cap rate. We take that new annual NOI of $177,600 and we divide it by our 6% cap rate, so 0.06. Doing this systematically engineers exactly $2.96 million in brand new property value. No joke, you literally forced almost $3 million of equity out of thin air simply by optimizing your operations and upgrading the physical space.
I want to leave you with a sobering warning to end our explainer today. We call it the PRI paradigm. Never renovate units faster than the local market can absorb them. Seriously, if you take 20 units offline simultaneously in a submarket that only sees, say, 5 apartment moves a month, you will artificially spike your own economic vacancy, hemorrhage your cash flow, and completely derail that beautiful math we just looked at. You absolutely must move in calculated, sequential phases. So as you look at your own real estate portfolio and your goals for scale, ask yourself this: is your operational pacing truly as calculated as your financial ambition?